Hello and welcome to the Taxcast, the Tax Justice Network podcast. We've got something a bit different for you with this episode. It's a joint podcast with the brilliant Byline Times podcast and its host, Adrian Goldberg. And we're talking about private equity. Private equity is something that's gone under the radar for a very long time. So what is it? How is it affecting our lives? We talk here to Hettie O'Brien, who's written a brilliant book all about it. For us at the Tax Justice Network, private equity demonstrates really well why we research and campaign for a better, sustainable economy, transparent ownership and a fairer tax system. A tax system that can also act to rein in damaging economic activity, something you see a lot of with private equity. So here it is. Your usual Taxcast will be out soon. In the meantime, enjoy this listen.
Hi there and welcome to the Byline Times podcast from the Byline Times with me, Adrian Goldberg, this time in conjunction with the excellent Taxcast podcast and its presenter, Naomi Fowler. Hi, Naomi.
Hi, Adrian. And we're looking at private equity today. It's a financial beast let loose in the 1980s. It's having profound consequences for private enterprise and public services.
Yeah, whether we're talking about pubs, care homes, the water industry, investment funds have seen value and extracted it both for investors and themselves, but often at the expense of the customers who pay for those services.
So how did that happen and what can we do about it?
Well, to answer that question, or those questions, we are joined by Hettie O'Brien, who recently published The Asset Class, How Private Equity Turned Capitalism Against Itself, which is an immensely readable chronology of both the ideology and the impact of a financial instrument that most people are unaware of, but which has a huge impact on our daily lives.
And we're also joined by Alex Cobham from the Tax Justice Network, and he's got a few ideas about how to tame the beast and put it back in its cage.
So let's get cracking. Hettie, let's start then by understanding what private equity is, or at least private equity in the sense in which you mean it in your book.
Well, I think when I try and explain private equity to people, the term itself doesn't actually do that much to help because it is a sort of form of camouflage. It doesn't tell you anything about what private equity involved. And so I think of it as you're thinking about something called a leveraged buyout. And that's really at the heart of what private equity has historically been about and is still about. If you or I were to go and buy something using a credit card, we would typically expect to pay off that debt and we'd be responsible for servicing that debt. When a private equity fund buys a company or a form of infrastructure or asset of some sort, they will load that debt onto the company or asset they have just acquired. They will borrow the money and they will ensure that it is somebody else's responsibility for paying it off. And when you think about the consequences of that debt, not only does that model encourage forms of recklessness and risk-taking that you or I might be inclined to involve if we were the owners of a company, but also it means that that company has less cash available to service other ends, whether that's making products or providing a service, providing a care home service, say, to your elderly relative, because that company is spending more and more money on servicing debt. So that really is at the heart of what private equity is. And as you say...
Okay, well, let's just try and break that down, though. Traditionally, if you were trying to buy a company, you might invest your own money to buy that company and take a risk on improving that company. And if that company was then successful further down the line, you would get some reward for your investment. That's kind of how capitalism traditionally worked. And you might also go to a bank, let's say, and as well as your own investment, you might get the bank or another investor to help you out in making that purchase. But there would be some risk involved to you, so that if you didn't turn said company around, you would lose your money. And what's clever about these leverage buyouts from the point of view of the investors is that they generally, the investment funds put very little of their own money in. They'll borrow huge amounts from banks and other investors, but those borrowings then are put onto the company, so that if the company fails, it's the company that takes the hit. And there are interest charges on those debts. and those interest charges are paid by the company. It's how the Glazers bought Manchester United, for example. That's how it works. Is that right?
Basically, that's right. And you could argue that this isn't really capitalism, at least in the sense that we understand it. We think of, or at least we've been told, many of us have come to believe that capitalism is a type of kind of entrepreneurialism, involves risk-taking, involves the production of things that didn't already exist. Actually, this is a model of outsourcing risks. It doesn't really involve taking risks at the level of fund managers. And it's also deeply opaque in the sense that we can't see exactly what the consequences of all this borrowing are for these companies and how much of the taxes that they're managing to minimize through interest payments, as you've kind of alluded to there, or how much of their profits are going offshore and so on. So yeah, I think for a lot of people, this doesn't really look like capitalism in the free market, blue-blooded sense of that term that we're used to hearing.
Yeah, so if people think of some of the big names in this world, people like Blackstone, which is a US company, or in the UK, Terra Firma, which was run by a guy called Guy Hands. And you outline really how those companies were essentially it's all about de-risking, isn't it? You take over often distressed companies, you will charge them management fees, which means that any investment that you've put in will actually be covered by the management fees that you charge for the companies that you're running. But again, crucially, this idea of putting the interest payments of paying the initial loan which you used to buy the company onto the company itself. That's the bit where, as an investment fund, you're de-risking and making sure that whatever happens, you're not going to be out of money.
Yeah, that's correct. I mean, when you think about also how we tend to think about debt, at least in the public sphere, ever since 2008, really, we've been sold on this idea that austerity is necessary because debt should be avoided, because public borrowing is impossible or unfeasible. And so on one hand, you have this acceptance of public austerity when it comes to the funding of infrastructure and so on in the public realm. But on the other hand, you have this massive buildup of private leverage, and that's having real consequences, both for the infrastructure we depend on, such as water companies, care homes, and so on, but also because it's helping to arguably destabilize the financial system. And that's what regulators are really worried about now. They're thinking, hold on, has this gone too far? What's all this leverage going to do if this suddenly bursts?
Just want to go back to the ideology as well of this, because this goes back really to the 70s, doesn't it? And maybe even earlier, but you talk about the sense that people who were behind the origins of this kind of private equity were anti-bureaucracy, anti-state involvement. A lot of it was driven by this sense of the private enterprise can do things more efficiently by government. We're all familiar with this kind of ideology really from Thatcherite times onwards. But this sense of get the state out of our hair, let private enterprise manage these things because they can do it so much better.
Yeah, I think that's true. I think there's also there's one really interesting character I write about in the book who I really loved finding out more about, which was William Simon, this guy who played a really important role in the Nixon administration. And he made a number of trips to Russia during the late 1970s or mid 1970s. And he saw in the communist Russia this kind of creeping threat that was spreading outwards from Russia to Europe and then would eventually infect America. And he then left government and founded one of the first leverage buyout operations in the US, which Blackstone actually looked to as a model of how to do business. So it was really very much an inspiration to others working on Wall Street, what he did. And to him, leverage buyouts really were a way of instilling greater control across the whole economy on the part of a very small group of very rich men who basically do remain unaccountable to the rest of us. But also when you look at where that's taking the economy more broadly, or at least the political economy in politics in general, you can see this traces almost as a return to the pre-1929 American economy, where you don't have the same forms of transparency, you don't have the same controls on basically what look today more and more like oligarchy. And you have, in a sense, this economy that is deeply private, where wealth is held in very few hands, and where there is a massive problem with things like investors getting ripped off, ordinary people getting ripped off. And arguably, that's where America's economy is currently headed, and what the Trump administration seems to be hoping to bring into being.
And this was it kind of really took off, didn't it, in Reagan's times in the United States, but also enthusiastically adopted here in the UK, as I mentioned, from Thatcher's time onwards. Private investors managed to persuade government, private equity managed to persuade government that it was better at handling large sums of money and large-scale projects, whether we're talking about railway privatisation, which I know came later in Major's time, or whether it was care homes. Private equity was capable of and better than the state at handling these areas of important public life.
Yeah, and you see that today increasingly as well, where you have this reliance upon private capital to fill the goals left by the retreat of state funding, and a sense in which this can help square the circle where the current Labour government has set itself very constricting fiscal rules that it needs to abide by. So it doesn't want to borrow more than what it's already set out. And so therefore it's increasingly relying upon private capital to do that work. But that then shapes the types of investment you end up with. So you hear a lot about infrastructure, and you think about that as something that would basically improve your life, whether that's a road or a railway or something like that. And then you see actually what infrastructure means when thinking of it from a private equity perspective is something like data centers. So you get Keir Starmer announcing on LinkedIn that Blackstone is helping to build new data centers in Britain. And isn't that a win for Britain? Well, not really, if you want infrastructure rather than just real estate speculation. So I think it really also, that approach shapes the types of things we end up with as a society.
In terms of where private equity went wrong then, or is going wrong, just point to some of the examples, because your book has got lots of human stories in it. Just give us a sense of where this plays out and how this impacts upon real lives in a negative way.
I think one of the most visceral places where this happens, and I really did try and tell this story through in a way that would mean that it wasn't just black and white, and that it also was engaging and exciting for people to read about rather than kind of remote and abstract. But one of the places where it really goes wrong is with care. And there's lots of interesting academic research on the impact of private equity ownership on care homes. One study I came across in the US analysed, I think it was something like 100 private equity deals, takeovers of care homes, and found that after that takeover had happened, the mortality rate at those care homes increased by an average of 11%. Similar story in the UK during the first wave of the COVID pandemic. At care homes with the highest amounts of leverage, which is another word for debt, the death rate was almost twice greater than it was at care homes with no leverage at all. So I think that's when you start to really see the human impact of these business decisions and how they're affecting people's lives.
We've seen it in the water industry as well, haven't we, where you've got some water companies privatised in the UK, taken on huge amounts of debt. Those water companies now saying to the regulator, we need to increase our bills to our customers, but some of the money that customers will pay will be paying debts that were acquired by previously debt-free water companies, but debts which have allowed the people in the private equity firms behind them to take out vast sums of money in management fees and interest payments.
Well, the purpose of that debt was very often to enrich those investors rather than to invest in the thing that it's supposed to fund, which is improvements to the service they're providing. So we're basically paying twice, once for the debt and another time now for the actual improvements that were supposed to happen already. But also, when you look at the amount that you're paying out of this stuff can sound abstract, it can sound remote, but actually when you look at what that means for your monthly paycheck, your water bill, it now involves, if you live in England and Wales, something like 28% of that bill goes on paying off debts, dividends, and other forms of financial extraction. And those things haven't actually led to a better service. So I think that's something that really rightly outrages people.
Naomi, what struck you reading the book? What did you draw from it? Because I've got to say, it's a very tightly told story, and those stories around care homes, around water, which to some extent we're familiar with, I suppose, in the UK, did really strike home. And you're hard pressed to think of a way in which private equity could ever be seen as a good thing. It's certainly in the way that it's used in these leveraged buyouts.
Yeah, definitely. I thought it was a brilliant book, very accessible, very readable. It just throws out so many issues and it does seem abstract, but actually I think we're just not aware of how much it's affecting our lives on a daily basis. It really, really is. And that really comes across in the book. But I mean, it makes you think about, the word investment, what that really means, because it means very different things to different people. And, in who's investing what and how useful is that? And the way that we look at it at the Tax Justice Network, private equity is right at the centre of what we refer to as the finance curse, or too much finance, where, you've got a finance sector that is too big and that is actually a drag on the economy. We're seeing our economies are just flatlining. It's really fueling inequality to unprecedented levels now, I think. And maybe Alex can give us an idea really of that type of context in terms of private equity and how important that is to what's going wrong with our economies.
Thanks. I mean, I really, Hettie, congratulations on the book. I really enjoyed it. And I think you tell the story very well. One thing that struck me is, you start with this story of leveraged buyouts and how, people like Simon targeted not the public sector, but, big private sector companies that they felt were inefficient, chauffeur-driven cars for the chief execs and so on. And they started stripping out, paying people a bit less because you could. And you think, there's an efficiency argument there. You can see this maybe making the economy work better. But then this transition to actually working out, where is it in the economy that you've got guaranteed streams of income? Well, it's mainly the public sector and it's absolutely fundamental necessities. It's water, because we'll never stop needing water. We'll never stop needing care and so on. And when you look there, well, what are the efficiencies? Actually, the efficiencies aren't really necessarily about paying people a bit less, although we're going to do that too. They're about challenging the assumptions. So there's an assumption that we will provide the water at as high a quality as we can without interruptions. Actually, though, we can challenge that assumption because we're not going to face a financial penalty if we don't do those things. And in fact, we can make more money by providing dirty water, by allowing interruptions, by having death rates in care homes that are higher because there is no financial penalty for it. And so efficiency in the private equity model comes into the public sector, comes into things that affect our lives with this guaranteed income stream, but also a guarantee that we're going to perform worse on the things where there is no financial penalty. And it turns out that actually a great many of the things that we care about, that people's quality of life depends on, are subject to these efficiencies, right? And so what we lose are all the things that we care about because there's no immediate financial penalty. And so, thinking about this idea of too much finance, there's a long economic literature now about once you have private credit that's too big a share of GDP, instead of it being helpful, instead of it, funding businesses that are going to do productive things and so on, you actually end up funding consumption to levels that are damaging to the economy. And so when finance gets too big, GDP growth gets slower and inequality gets worse. This isn't just limited to private credit. When we look at the financialization of the whole economy, and that's really the story that Hettie tells here, the bigger things like private equity get in the economy, the less productive the economy becomes, because everything is
I think that's a really, really important point, Alex. And I'll come to, and you've got some ideas about how we kind of control that and how, to use the phrase from the top of the podcast, how we tame the beast. But Hettie, just one thing struck me quite early on was this sense that in a sense, you're not making an argument against capitalism. In a sense, what you're saying is that this isn't capitalism, because capitalism in its purest, rawest form involves risk, involves people who have capital, putting that capital forward and making an assessment that they can improve a company or they can build a company using that capital. If it works, they make more money. If it fails, they lose that money. But the trick here was to ensure that you couldn't lose. And but somebody else has to pay for it, of course, whether that is the company itself and its employees, whether that is the taxpayer, if it's a public service. This is the point, isn't it? It's kind of posing as capitalism, but it isn't really capitalism, as most people would understand that phrase. Or is it? You're looking at me doubtfully when you say that.
I think there's a lot of arguments as to what capitalism is or isn't. Actually, I suppose it looks different depending on where you are in the history of capitalism. So 20th century, you had the search for the new frontier for capitalism in the form of imperialism, heading overseas to find new areas of untapped value. 21st century, you had the invention of all these kind of exotic mortgage-backed securities and credit products. And late 21st century, where we are now, or the 2020s, you have private equity. And as someone put it to me recently, it looks like a kind of cannibalistic frontier where instead of heading overseas or creating these kind of temporal products to do with credit, it's actually looking at the services that we rely upon in an everyday sense. And the irony there, the great irony that looms over the book really, is that you have this thing that was invented ostensibly to make capitalism work better, or at least rouse Western economies from their economic slumber. And actually, it's ended up undermining the institutions that capitalism really depends upon to reproduce itself.
Yeah, no, and I think you make the point quite early on as well that instead of funding, let's say in a UK context, the UK equivalent of Silicon Valley, there's all this money sloshing around in the economy, but it's not actually creating new things which will power the economy forward into the future. It's simply recycling the money and diverting whatever extra money is made back to the people who made it so they can do it again. But it's not actually triggering growth, which is what we're told is
and that helps to explain the British minister's love affair with private equity is based on the idea that it's supposed to be this kind of form of venture capital, which is the type of thing, the shiny, impressive thing they have in the United States that creates iPhones and electric cars. And actually, that's part of the reason Britain ushered in this industry and provided it with the tax breaks that it enjoys today. But when you look at what it is, it's actually in Britain, at least, very much a way of snapping up companies on the cheap and loading them with debt, or just doing distressed buyouts of W.H. Smith, Claire's Accessories, and so on. So while we get T.G. Jones, the States gets Silicon Valley. And I think there's a kind of interesting juxtaposition there. And I think that British prime ministers, or at least governments, have continually made that mistake of assuming that this is going to be the leading form of quote unquote investment.
But America has private equity. I mean, that's where it started, this kind of private equity. But they've also had Silicon Valley as well. Why haven't we in the UK been able to have both?
I mean, I think there's a lot of answers to that. And to be clear, venture capital is not without its own critics and problems. But if you look at the history of that in the US, it's closely tied to forms of public and state investment in things like military technology and so on. I think the risk that and I keep saying we, what I mean is governments. I think the risk that governments take in the UK is the assumption that the private investment will just come of its own accord. What you often need first is the public investment, because that then plays a role of attracting that private investment. That really is the history of Silicon Valley in the US, but it doesn't look like one that we're going to be repeating anytime soon in Britain.
Sorry, Naomi, I interrupted.
Yeah, I think it does come back to that word investment and what that actually means, who's investing and what kind of useful things are they investing in. And we can actually properly tax and regulate this stuff. It is really important to understand that there are ways to tackle that. We're always saying at the Tax Justice Network that tax is our social superpower. And a lot of people focus with tax on just the revenue raising aspect, but it's about a lot more than that, because you can use tax to disincentivize certain activities that are not beneficial to the economy, and they're not beneficial to people. I don't know if we've got time for Alex to talk a little bit about that, but I think it's useful.
Go on, Alex. Yeah.
I mean, I think there's a couple of things in there. One is the way that, Adrian, as you said repeatedly, this thing of the separation of who is bearing the risk and who is getting the return. And that's the sort of the original problem in private equity. By allowing the kind of the previous quid pro quo to be broken, we end up with people who just extract an income stream and don't bear any of the risk. And that's kind of the first thing that you'd need to tackle to fix this. But then the second one, and again, Hettie goes through this very, very well, is the way that governments have decided that they actually need to sort of to give in to the lobbying of what became this very powerful industry and give them an even better deal. So on one hand, they've got this separation of risk and they're extracting income without taking the risks. And then on the other hand, they've managed to get this really sweet deal where basically their income is treated as a type of capital gain that's taxed at a very, very low level, if at all, because you then structure it in all sorts of careful ways to add more obstacles to taxation. So you've got a model that is bad and extractive and pushing the risk onto the rest of the economy, which is effectively now being subsidized because governments treat it so favorably. So there's two ways into kind of challenging that. One is to say, firstly, we have to break the model. We have to fix the risk problem. And this is what Elizabeth Warren's proposal really does very well. It says, in effect, you wouldn't be allowed to take on a business and load it up with debt that didn't tie back to you, that you weren't ultimately responsible for. We have to put that link back if we don't want this cannibalization of the economy to continue. And for as long as governments think private equity is still the next great thing, they're not going to do that. So this book is really important, I think, to shift perspectives and the narrative on that and move us towards at least considering that kind of policy option. Well, and then the second piece.
Go on. So I'm just sorry. I don't know whether this one for you, Naomi. I'll come back to you, Alex. But I mean, why are politicians then so blind to this? Because some of the problems evident that Hettie outlined so well have been evident for a number of years. Hettie has the example of the pub trade and the pubcos that were created, and anybody who's looked into that will know that the creation of pubcos was not in the interests of pubgoers, not in the interests of the people who took over licenses of the pubcos, but it was very handy for the pubcos themselves. These problems have been evident. So what is there just kind of an ideological fixation with?
I think it's simpler than that, personally. I think you have to look at party political financing, disproportionate influence that very over-powerful actors have in our economy and over politicians. You've got to look at things like the revolving door, where politicians go out of supposed public service straight into, the boards and they have a lot of other interests going on, even while they're supposed to be working for the public in the public interest. So I don't even know that it's about ideology often. It's actually, follow the money. I think that's really where you have to look, and you have to really get money out of politics, I think.
Yeah. Go on, Alex. Sorry, I interrupted you. I was keen to hear that.
Oh, no, just, the second piece would be on tax. The other thing that we're doing, as I say, is really subsidizing this extractive model very heavily by giving it such favorable tax treatment. We have to reverse that. We have to at least require that all of the gains through private equity are taxed at the same level as anybody else's income would be, because otherwise we're always incentivizing, we're always making it more efficient, if you like, for this to be the model that dominates our economy. And why would we do that when we can see, when Hettie has shown the damage that it does? Basic stuff, but it requires the political commitment to say, we are going to challenge what is now probably the most powerful financing model in our economy. And how you get there is a serious challenge.
Mm. Go on, Hettie, round it up for us then. What do we need to do? And it is doable, isn't it? There is, with political will, this is very changeable. I mean, this is a way of being that has come into the world in my lifetime. So if it can come into being, it can be put out of being as well, can't it?
Yeah, and I think that, look, I really wanted to change people's minds on this, and that's why I wrote the book. And I wanted to do it in a way that people would hopefully read and find fun at the same time. But I think that if it was up to me, I think it would require that mindset shift. Alex's proposals are very spot on, actually. But I think it's also about a mindset shift of realizing that we have accepted this situation of public austerity and private leverage. And actually, we end up paying for it. It's not a cheap way of doing investment. It's not a cheap way of organizing our lives. It's not a more effective way. Actually, it can be very much more expensive. And it also has all of these terrible implications when it comes to public services. So I think calling that out is the best place to start. And then hopefully people who are working on policy will take inspiration from this and will think, okay, what can we do? These tax proposals sound very persuasive to me. So I think more of that sort of thing would be great.
Been a really interesting conversation. Thank you for your time. That's Hettie O'Brien. Hettie's book, The Asset Class, How Private Equity Turned Capitalism Against Itself, is out now. Thanks also to Naomi Fowler from the Taxcast and to Alex Cobham from the Tax Justice Network. I'm Adrian Goldberg, and this has been a mixture of the Taxcast and the Byline Times podcast. Thanks for listening. Cheers now. Bye-bye.